Hello, I'm Troy Harmon, Chief Investment Officer for Henssler Financial. I'm here with Nick Antonucci and Jacob Keene, and this is your market update for August 2018. So guys, GDP, solid number, 4.1% growth. Reported last month. That's what, our second quarter number?
That's correct. Expectation was for 4.2%, but
a little bit
still much better than the 2.2% that we saw at first quarter of 2018. Yeah. Great report.
I think some of that's been driven by the fiscal stimulus, and some of it is also, I think we've seen export growth too, which I think is commodities driven, which really drives us into what we're seeing inflation-wise.
Right.
If you look at the headline number, we're at 2.8.
Right.
If you look at core,
2.2.
2.2. So some of that's food and energy driven, but inflation, relatively high.
Yeah, you look at the PCE deflator, we're around 2.3%, and that's the one that the Fed looks at. That's the core PCE. So, all things considered, there's a little bit of pressure on prices, which leads
above their target.
It is, yeah. Their target's 2%. Employment situation, some of that, wages are driving some inflation, but still, overall inflation, I think, is above that.
Speaking of employment situation, we got our latest, our July jobs number. 157,000 jobs were added. In the month, you saw revisions to both June and May to the tune of about 68,000 upward revision. Strong report. As you mentioned,
it was a miss of the estimates, but it was driven largely by the higher wage sectors.
Correct.
If you look at business services, healthcare, manufacturing, and that compares to earlier on a year or two ago where we're seeing a lot of it driven by restaurants, these part-time jobs, and we're even seeing year over year we've got the underemployed rate is down over 12%, which is showing some health. And I mean, obviously, jobs are healthy right now. We got unemployment at 3.9.
Yeah, and unemployment did tick back below 4% this month to, like you said, 3.9%.
And I think with growth and inflation up, we're seeing rates moving up a little bit.
No doubt, yeah. Interest rates are definitely rising. We can go out and buy a CD now, a 3-year CD at 3%. It's been a long time since we saw those possibilities. While rate increases usually tend to put a little bit of a brake on economic growth, those investors that are looking for fixed income actually get a bit of a benefit from that.
So talking about rates, in September, we're going to have another Fed meeting, expecting a rate increase there, 94% odds that it does happen.
That's pretty strong.
That will put the Fed funds rate to between 2.25% with the expectation of a second one in December.
Right, yeah. If you look beyond there, we don't really see the probabilities of an interest rate increase until May, but that always changes.
It's hard to forecast out that.
Sure.
No doubt, yeah. So rate hikes are in our future, but if you think about everything we're looking at, it feels like we're kind of late in the cycle, late in the business cycle. So, we've had this extended growth from our previous recession back in 2009. But when we look at all the indicators as to whether or not we're going to have any slowdown anytime soon, we really don't see that yet.
No. We've seen, the yield curve flatten a bit.
Yeah.
But beyond that, I don't think rate policy has yet gotten to the point where it's subtractive to growth. I mean, if you're talking about a 10-year at 3% and inflation at 2.9, I mean, it's not really tight.
Yeah.
Also, in this year, we've seen earnings really strong.
Yeah, second quarter, 24.25% earnings growth in the second quarter.
Yeah.
Looking forward into the third quarter, it's still at 25, somewhere in there.
That's where they're expecting, yeah. Had 22.5 in the first quarter earnings growth. I mean,
and that's really that's driving the market too. If you look year to date, the S&P 500 is up 7.08%. We called beginning of the year 6 to 8% total return, and July itself was a great month, returning 3.72%. So earnings are driving stock prices higher for the year.
Yeah, we still stick by that 6 to 8%. It's below the long-term average, 10.5% that we see in the S&P 500, but a lot of that is valuation driven.
And I think one of the interesting things that we've seen late July is a little bit of a rotation from what was a growth and momentum dominant market. You think the FANGs, the leadership like that. That's faded a bit, and we've seen a bid in the value type sectors, the value type names, some of these lower PE stocks that have been beaten down. And I think that's an interesting look to the market.
Yeah. As a person that looks at the fundamentals of of companies for investment. It actually is a bit heartening to see that finally the valuations that you think seem more reasonable are coming back around. So earnings solid. Don't really look at the market as having excessive risk at the moment. Still all invested and recommend the same from everybody else. So this has been your market update for August 2018 from Henssler Financial. We thank you for watching.